Folks, welcome back to the Contrarian Trader. This is Robert Desmond. It is Sunday, August the 22nd, 2010. The last time I had posted on YouTube was on July the 18th. And at that time, I had indicated that the rally we had predicted early in July was just about over. And sure enough, we did get a couple of additional days of rallying, especially in the large caps. Large caps did fairly well. The smaller caps broke down earlier and much harder, which was anticipated because the earnings came out of the large S&P 500 companies because they have an international exposure, whereas you have your smaller cap companies that are basically the domestic companies with not as much international exposure, and besides the fact they don't know what to do with their businesses, they can't get credit. They don't know if they should hire. And this goes the same for all businesses in the United States. They don't know whether to hire because they don't know what the cost per employee is going to be. Thank you, President Obama and the Democratic Liberal Congress. And speaking of President Obama, the summer of recovery, as he likes to proclaim it, is done. It never existed. And sure enough, last week, they just put the nails in the coffin, and it was all over. You had housing starts last week, which came in lower. The building permits, which I place a lot more emphasis on, came in lower as well, and that's a forward-looking indicator. So in terms of sopping up demand in the marketplace, it's a good thing that they're not building new houses. That's good because it'll take the current inventory off the market that much more sooner. But that doesn't tell us that there is demand that's growing in the economy. You have interest rates at 55-year lows, and people still aren't demanding mortgages. They're demanding refinances. It's because they're so in debt, and they need to refinance. They're going to take whatever equity that remains, if they are lucky to have equity in their home, pay off credit card debts, and that'll go from being unsecured credit to becoming secured credit. So if they default on those credit card on their debt, now their homes are in crisis or could be threatened. So it's in the long term, it's a smart move. For some, it could be a double-edged sword. But I think net, it's a smart move that the refinances occur. I mean, you can go from 23% on some credit cards or even higher down to 4.25%. It's a smart move. The S&P 500. We're pretty much where we were the last time I had posted on YouTube. Not much change here. The head and shoulders formation that we're seeing setting up here is in effect, but with the summer doldrums, I don't know if much is going to happen before Memorial Day. So what I'm thinking is that we're in a trading range for the short term anyway, and I don't think we're going to see a rally anytime soon because we attempted to rally above the 1100 level last week, and it failed. It broke right down below it. And this is a weekly chart of the S&P 500, which gives you the macro picture. So we're still above that declining downtrend line. As a matter of fact, we're right there. I mean, if I extended this out, we're right there. We can go either way on Monday. Let's take a look at the daily chart of the Dow Jones Industrials. Now, here's where I posted back on the 18th. We saw some additional sell buying here, and then we broke down below this uptrend line, and that rally is dead. It's over. Okay, so don't even think that we're going to be breaking out higher anytime soon. Can we begin to have a shorter term rally here? Yeah, I would buy into that if we broke above this resistance here at the, say, 10.5 level, and perhaps we have a chance of breaking out higher. But you saw some pretty significant resistance here at the 10.5 level. The IWM, of which we are short. There is reason to get bullish of the IWM somewhat, and that's because it took such a clubbing like a baby seal over the head. And I'm going to go into, for those who don't know it, I go into much greater detail on the market. The YouTube only gives me 10 minutes to speak, 10, 11 minutes to speak. I go into greater detail because the videos are hosted on my server, so I go into greater detail on the markets and our current positions. So members, You know to expect the members version of the week ahead commentary. And for those who are not aware of it, there is a members the week ahead commentary. If you're interested, you want to hear it, please sign up for the 14-day free trial offer at thecontrariantrader.com, and you'll get that commentary and previous commentaries as well. RTH, as predicted, there's nothing happening here. We're right where we were on the 18th. It's a weak sector, and I would only expect it to get weaker. And real quick, I mentioned earlier the economic data that came out last week that put an end to the summer of recovery, quote unquote. We didn't touch upon jobless claims. For the retail sector to rally, you need jobs. You have to have jobs. And not only did we not get jobs last week, we had higher requests for unemployment benefits. And that's a major concern. And that number that was released last week was the highest number since November 2009. So we're not getting better, we're getting worse. The Philadelphia Fed Manufacturing Index was released last week. They were expecting a number of 7.5 increase in manufacturing. 0 is the neutral line, and anything below 0 indicates that there's a contraction in manufacturing. The reading came out negative 7.7. So they went from expected increase of 7.5 to a negative 7.7. That's a dramatic slap in the face to that region. And I believe that entails Ohio, obviously Pennsylvania, New Jersey. That area there is just getting hammered. This week, coming up, we have GDP for the Q2. Now, that was already reported about 2-3 weeks ago. They're going to come out with a revised number. The first number came out at 2.4%. The market has already discounted that down to 1.4%. If we see a break below that 1.4% level, look out below on this market. Changes to the Contrarian Trader website. They're coming soon. And I want to briefly go over that. What we're going to do is, since we're entering into this new era of lower yields on the market, we have members that have their long-term positions in stocks, yet they're not getting the yield that they need to live, to survive. So what we're going to be, and let me also rephrase, they are in bonds as well, and they're not getting paid anything. So what we want to do is begin to offer additional services, add value to our services, and that's on how to draw in additional monthly, quarterly income from the markets, and that's by selling covered calls and by writing puts. Now, when I say selling covered calls, it's also known as writing covered calls. And when I say write a call, write a put, that does not mean we buy them. That means we sell them. We are the banker. We want to be the banker in this type of market if we enter into a trading range. So when you write a covered call or you write a naked put, you bring in an income. And that helps to juice your net returns over the course of the year. If we have a market that's trading sideways, there's nothing better than having that income coming in. So we want to prepare ourselves for a longer duration of having low yields. And I'll tell you why. What you're looking at here is the price of the 30-year bond. Look at this. You want to find a bull market? It's in the bond market. You want to buy a bond, and it's going up higher in value, yet the yield is dropping off a cliff. And people need their yield on those bonds to survive. So for those members who join up before I have the new website out, again, this website is going to be scrapped soon. It's going to be replaced by a much more dynamic website, much more interactive. And what we're going to have is a premium service as well, which will include the covered call service, the option writing service on how to bring in income. And for those people who are members before that new website goes up, which should be a month and a half, then we will we will grandfather you in. Those members who are members now will, of course, be grandfathered in because I have loyalty to my subscribers, and they will, of course, get that for free. But the price of that service will go up dramatically for new members after the new website is up. So take advantage of the 14-day free trial now. Getting back to Apple really quick because I'm running out of time. I had the contest. I had a reply from Gert. Gert, you're the winner. You correct. We did see a Head and Shoulders formation set up on Apple, and a break below the neckline here would have been the trigger to get short of that stock. So congratulations, Gert. 6 months free membership to you. Everybody else, be safe in this market. Subscribe to my channel and be safe. Use stop loss orders. Have a great trading week. Bye-bye, folks.